Hello friends, welcome back to Mancy's Wisdom. Today I want to ask you a simple question. When do people usually notice greatness? When an athlete wins a gold medal, when a singer becomes famous, when a company becomes a giant. But here's something interesting. Success doesn't begin on the day the world notices it. Success begins quietly, long before the headlines. The stock market follows exactly the same principle. The biggest winners rarely announce themselves. They whisper first, and only later they make enough noise for everyone to hear. Today's chapter is about learning to hear those whispers, because fortunes are often created before the crowd even realizes something extraordinary is happening. Imagine a beautiful restaurant that nobody knows about. On the first day, only a handful of customers arrive. The food is exceptional. The service is outstanding. Slowly, word spreads. Weeks later, people begin waiting outside for a table. Months later, television channels feature the restaurant. Social media explodes. Everyone suddenly wants to visit. But who received the greatest benefit? The people who discovered it first. The market behaves exactly the same way. By the time television debates begin, by the time newspapers praise the company, by the time everyone starts talking, much of the move may already have happened. The greatest investors don't chase popularity. They recognize leadership before popularity arrives. So what exactly is a market leader? It isn't simply the biggest company. It isn't necessarily the oldest company. A market leader is a stock that consistently demonstrates strength. Its earnings improve, its sales grow, its price outperforms competitors, its industry becomes stronger. Institutional investors quietly accumulate shares, even when the overall market hesitates. True leaders often refuse to fall significantly. Strength attracts strength. Capital flows toward excellence. Professional investors understand this deeply. Weak businesses require hope. Strong businesses create confidence, and confidence attracts money. Here's one of the most powerful observations you can ever make. Watch what happens during market corrections. Suppose the index falls 5%. Some stocks collapse 20%. Others barely move. Now ask yourself, why? Because somebody is supporting them. Professional money often reveals itself through relative strength. The strongest students don't merely pass examinations. They consistently rank near the top. Likewise, market leaders consistently remain among the strongest performers. They recover faster, rise faster, and often begin moving before the broader market improves. Strength is rarely an accident. It is often a clue. Remember our previous chapter about volume? Today, let's connect those ideas. When genuine leaders begin advancing, price often rises with unusually strong volume. That tells us participation is expanding. Institutions cannot secretly buy millions of shares forever. Their footprints eventually become visible, and volume becomes one of those footprints. When you see higher highs, healthy corrections, strong earnings, and rising volume, pay attention. The market could be quietly introducing its next leader. Great opportunities rarely knock loudly. Sometimes they simply leave footprints for observant people. Many beginners believe a low-priced stock is automatically a bargain, but price alone tells us nothing about value. A stock trading at 50 rupees can still be expensive. A stock trading at 5,000 rupees can still be cheap. The real question isn't how low is the price. The real question is, how high is the quality? Market leaders often appear expensive. People hesitate. They wait for lower prices. Sometimes those lower prices never arrive. The strongest companies often become stronger. Instead of chasing weakness, learn to recognize excellence. Quality deserves attention, not because it's expensive, but because it consistently delivers results. The market rewards patience far more than excitement. Become an observer. Watch earnings, watch sales growth, watch industry leadership, watch relative strength, watch volume, watch institutional participation, create a watch list, study it daily. You don't have to trade every opportunity. In fact, some of the greatest decisions in investing are the trades you wisely choose not to take. Discipline protects capital, observation creates wisdom, and wisdom creates consistency. Let's conclude today's chapter with one lasting thought. The crowd follows yesterday's winners. Professionals search for tomorrow's leaders. Never let excitement replace research. Never let headlines replace analysis. Never let emotions replace discipline. Train your eyes to recognize strength before popularity. Train your mind to think independently. And train your heart to remain patient. Because in the stock market, the biggest rewards often belong not to those who move the fastest, but to those who see the clearest. Thank you for joining me for another episode of Mancy's Wisdom. In our next chapter, we'll explore another timeless principle that separates successful investors from the crowd. Until then, stay curious, protect your capital, study the leaders, trust evidence over opinions, and remember, the market whispers long before it shouts.